Hi, everybody. It's Saturday, September 20th, 2025. We'll start with our headline Money on the Sidelines. One of the things prompting me to bring up this subject is this headline from Bloomberg: U.S. stock volume spikes in third busiest day ever. In other words, more stocks were trading hands on Friday than almost ever before. Is this a sign that there's a ton of money just loading into the market and is going to propel it higher and higher? One thing that is often said by people like Tom Lee is he often references, hey, look at all this money on the sideline that could go into the stock market and could drive it higher and higher. And while growing liquidity does have to generally an effect of making asset prices go up, people like Mike Malone on Verified Investing, in his show recently, he brought this up, talking about measuring the amount of money on the sidelines not as just how much money it is by itself, because that's not super meaningful. One way to look at it is looking at money market funds as a percentage of S&P 500 market cap. And even in the past 5 years, we're not looking at loads and loads of money being on the sidelines ready to go in the market. It's only at 14.25%. And you have to get a paid subscription to see their version of this going back to 1999. And when it does go back to 1999, this actually averages quite a bit higher at 20%, suggesting there's actually a fairly low amount of money on the sidelines, historically speaking. This is another way to look at it going back to about 2000, sniped from Bloomberg, that I found on isabelnet.com, going back to 2001, showing that, we typically are in a range anywhere from 15%, in the worst of it in the great financial crisis. We were up almost 70%. So when money market funds, by the way, are near 70% of the market cap of the S&P 500, that's probably a good time to be buying it when it's that high. But we're not even at the average, which is estimated at 20%. Suggesting, if you're going to use the money on the sidelines argument, then it actually is lower than normal. Next up, community topics. What moves, if any, did you make today? Robschild on Friday sold all rare earth miners, the fund REMX. When I've brought up this fund in the past, I noted how, this is a long overdue, underinvested area of investment, rare earth metals. This very fund itself, REMX, dating back to 2011, was at a peak of $344 and now is only $62 still. But just to make sure, that we're aware that, the chances of going back to that price are most definitely in the future. How long in the future is hard to say. After all, part of the reason for this decline in 2011 was we were in it was a silver bubble at that time. There was some problems with getting rare earths with China and all of that, and those were some tailwinds. And there were companies that actually failed through this period when this thing really dropped. And looking through the holdings of this company, a lot of it is lithium exposure. A lot of it is metals that are involved with electric cars, magnets, solar stuff, stuff that is involved with green energy. And to be honest, where we are right now politically in the world, we had those tailwinds a while ago, and I feel like those tailwinds are dying off. And meanwhile, this fund is, it's gone up a lot. It's doubled really from the bottom. I made a ton of money in it, and as much as I want to have exposure to metals at all times, which has kind of been my mantra and my reasoning for holding on to this, where we are right now with market risk, and also me not seeing continuous environmental tailwinds to keep this going necessarily. I mean, it could easily rip up higher. I don't know what Mr. Market's going to do with this, but I decided to get out. I want to have cash for when the whole stock market goes down, which I am expecting to happen still sooner than later. If you want to keep up with my general portfolio holdings, explain my thought process and what I'm doing, again, none of this is advice. You can see my website, it's in the description, and I do have it updated now. Sorry, there it is, as of that last thing sold, and am currently now 15% cash, actually. That's not right. There, we fixed it, 22%. I'm very comfortable now with 53%. I'm exactly 75% basically cash. I count treasury bonds, even though I do have even leverage in this. It's part of the cash. It's the guaranteed return bond section. So, following Benjamin Graham's, advice, never have less than 25% equities and 75% bonds. And that's what my portfolio is to a T right now. Anyway, check out my website as well as the Daily Reminders macro reviews to see my thinking process with everything. If you haven't already, I recommend taking a look. Again, no advice. Next, discussing what's coming up next week. Obviously, who knows what's happening with the tariff updates. We are sure to see more of those coming. We also have PMI and PCE coming out, along with, I think, Costco earnings are on Thursday. Thank you very much, everybody, for watching, liking, subscribing, commenting, and supporting my work. On to the charts. SPX, S&P 500, a new closing all-time high. I thought Thursday was sort of a spinning top that could serve as a reversal to the downside. Instead, we pressed up higher, and so I adjusted some trend lines, matching what I got from Verified Investing, Ligero Soloway. He's connecting this high in March to all these highs. It's pretty much where we're at here right now. And I'll just say, too, as we're going higher and higher, this is a wedge. This is something that is getting tighter, getting into a smaller and smaller range. And if we do break out, the ride down, I think, can go very, very fast and very, very, very far. A lot further than most other people will say. Remember, I am in the camp where part of my crystal ball readings involve that the Fed won't cut fast enough to save the economy, and the S&P 500 dropped at least 50%. Next up, the 10-year Treasury note yield. Still rising, still just basic pattern-wise, we're still below 50% of this bear flag pole, and it's going up at a slower rate, suggesting to me that it's going up not super aggressively. It's more of trying to squeeze out perhaps leveraged positions that we're expecting the 10-year to be dropping here. This is a weak move to the upside. I strongly believe the 10-year will be headed back down next week. And I do think next week we will be breaking the 4% level to lower lows. If we don't start heading in that direction and the 10-year does start rising and rising, we're going to have to question what's going on with the Fed. The Federal Reserve knows very well that the U.S. right now, in its fiscal deficit situation, cannot afford to have the 10-year Treasury note yield go higher and higher. And with inflation being where it is, it's like they're not going to be able to continue cutting. And the unfortunate reality is that just like crude oil, the 10-year Treasury note yield is good if it just stays where it is. It just plays by the rules and just stays steady. But it's controlled by the secondary market. It's controlled by you and me and other foreign governments, institutions deciding on what they think the 10-year guaranteed dollar yield should be. And ultimately, it is this, that's U.S. 10-year Treasury note yield, that sort of dictates the Fed what they must do. If this runs away to the upside, the Fed, is no longer in, and the Fed, let's say the Fed funds effective rate stays steady. Well, then not only are they in a neutral rate already, where we are in the Fed funds rate. But that is actually saying that we are in an easing state, that the Fed funds is too low. And then what happens after that? Well, we're actually going to have to hike rates. If the 10-year Treasury note yield starts running away to the upside, we should start seeing Fed funds futures start to price in actually some hikes and maybe no more cuts. You can't be cutting while this is rising. Again, the ideal situation for the Fed is we want to cut to be, a decent amount below the 10-year Treasury note yield. That's what the plan is, and hopefully that can help the jobs market not continue to show more cracks and the LEI continue to fall. The Fed wants it to go sideways. That's the good scenario. That's the Goldilocks scenario, is if the 10-year Treasury note yield doesn't move. Going down means we're headed into some kind of recession or depression, and going up means that we have, basically runaway inflation, that the Fed is, in that case, is going to be forced to actually raise rates. Uh, but anyway, I'm just repeating myself at this point, but the point is that this is the most important thing to be watching right now, in my strong estimation, the 10-year Treasury note yield. Where is it going to go next? I still think we're in a bearish pattern. I think this is headed lower, but let's keep a really close eye on this. The next thing I want to bring up is gold, only because it looks like to me, just very basic chart reading standpoint, is this not a head and shoulder looking thing forming? This could be what it is, and especially if the 10-year Treasury note yield starts dropping, that could coincide with gold dropping, as seeing the trust going back into debt, trust going back into yields being attractive, and to the point where it can actually roll over in that direction. This could be what's forming here. Next up, I want to bring up Bitcoin. This red candle was Friday's candle. Now, while the stock market pressing higher on Friday, it was very, very interesting to see Bitcoin actually drop 1%. And even more interestingly, hit this trend line that I've been talking about since 2017, getting rejected here very frequently now. Overall liquidity seems to see what's going on first in Bitcoin and then the stock market. The stock market has been following Bitcoin, and so it was very notable to see Bitcoin drop, not just a little bit, but with a pretty good sized red candle, down 1.2% on the same day the stock market hits a new all-time high. Bitcoin's not hitting an all-time new high right now. It all tells me that I do see in my crystal ball and all the stock market rolling over next week, along with the 10-year Treasury note yield. But remember, guys, it's all a bit of guesswork here. Last thing I want to bring up that makes it feel like even more so that the stock market is just so dangerously high, almost like Mr. Market has 3 porcelain dolls and is juggling them, and it's got the stock market, it's got the crypto market, and Bitcoin on its own. With the S&P 500 already being so incredibly overvalued, it's notable to me that the 1 day performance, 1 week performance, look at technology being the top performer. 1 day, 1 week, 1 month, 3 month, technology is second to the highest, and half year, and 1 year performance. Tech is just leading the way across the board. I think we're nearing the end of the AI bubble, but that's just me and my crystal ball. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.